You know that feeling, right? You've just funded your account, your finger is literally hovering right over the buy button, and you can already taste the gains. Honestly, getting started has never been easier. We've got these frictionless apps and fractional shares sitting right in our pockets. But here's the really uncomfortable truth that nobody tells you when you're just starting out. A massive number of new investors actually lose money, or they badly underperform the market in their very first year. Welcome to This Explainer, where we're going to break down exactly how to protect yourself and actually build lasting wealth.
So why do so many beginners lose money? It's a fantastic question, isn't it? I mean, you might think it's just bad luck or a terrible market, but honestly, it is almost never bad luck. The reality is, that exact same phone that lets you invest with just one tap, it also lets you completely wreck your portfolio with one tap. And it's because of 5 specific, predictable, and totally avoidable psychological traps that catch even the absolute smartest people. These aren't just silly rookie errors. They're deep behavioral flaws that most of us just stumble right into without even realizing it.
Okay, let's dive into this roadmap. Today, we're looking at operating without a plan, letting emotions drive your decisions, the one-stock obsession, trying to time markets, and finally, hidden fees and dangerous leverage. We're going to systematically dismantle every single one of these traps and replace that terrible gambling anxiety with a calm, rule-based approach.
All right, let's kick things off with mistake number 1, operating without a plan.
Think about it like this. You wouldn't try to build a house by just nailing random boards together hoping a living room magically appears, right? But shockingly, that is exactly what investing without a plan looks like. People just jump right in, buying whatever ticker is trending because they never pause to answer 2 basic questions. Why are you investing, and when exactly do you need the money? Just look at the contrast between these 2 scenarios, because your time horizon literally changes everything. On the left, if you're saving for a house in 5 years, you absolutely need to protect that cash. You want stable assets with way less volatility, because you just can't afford a bad market year right before your deadline. But on the right, if you're investing for retirement in 30 years, time is totally on your side. A market drop isn't a crisis, it's just noise on a really long chart. When you don't have a plan, every single red day feels like a personal attack.
So here's the crucial fix. You need to write down what I call the 1-paragraph plan. Think of it as your own personal investing rulebook. It really only needs 3 things: your goal, your time horizon, and your strategy. So, for example, I'm investing for retirement in 30 years, so I'm going to buy low-cost index funds, and I absolutely will not sell based on fear. Boom! That's the whole shebang. From this moment on, every single future buy or sell gets checked against this simple paragraph. Friend hypes up some can't-miss coin, you check the plan. Does your plan say, gamble on hype? No, it doesn't. Decision made. Moving right along to the most destructive trap. Mistake number 2, letting emotions drive decisions.
Look, we all really like to think we're these totally rational, calculating robots with our money. But the truth? We are deeply driven by fear and greed. Human brains are wired so strangely. We actually feel a financial loss about twice as hard as we feel the exact same sized gain. So when your screen inevitably flashes red, your brain just screams at you to do something, anything to stop the pain. And usually, that something is slamming the sell button. But you gotta remember, historically, the market has double-digit drops in plenty of years that still finish out positive. Panic selling is tragic because it turns a temporary paper loss into a permanent, very real one. Plus, the market's absolute best days often come right on the heels of its worst, meaning the panic seller locks in that painful loss and completely misses the rebound. Let's fix this. We need to build a system that basically overrides human nature. First up, automate your investing. Set up automatic contributions every single week or month, no matter what the news is yelling about. This is dollar-cost averaging, and trust me, it is the ultimate antidote to emotion. Second, you've got to enforce a strict waiting period for any manual trades.
Let me really hammer this home for a second. 24 hours. Consider this your mandatory, non-negotiable circuit breaker. If you get some sudden burning urge to make a trade that breaks your plan, you don't touch the app for 1 full day. Close it. Go for a walk. I promise you, 9 times out of 10, that manic urge to buy the latest meme stock or sell everything out of pure fear will totally pass, and you'll realize it was a terrible idea.
Up next is mistake number 3, the one-stock obsession.
It is incredibly dangerous to just fall in love with a single company and risk, say, half your portfolio on one hot tip. Any company, literally any company, can fail, get disrupted, get sued, or just be terribly run. One single bad earnings report should never have the power to wipe out your financial future overnight. So use the 5% rule. If you absolutely have to scratch that itch of picking individual stocks, build yourself a safe sandbox. Never, ever put more than 5% of your total portfolio into any single stock. If you have 10 grand, no single company gets more than $500. That massive 95% chunk of your pie, that stays securely parked in broad, boring index funds. That way, you get to have your fun, high-conviction picks without ever betting the house.
Because as the famous saying goes, diversification is the closest thing to a free lunch in finance. And it's so true. When you buy just one single share of a broad index fund, you're instantly buying a tiny slice of hundreds, maybe even thousands, of companies across every sector. It is one-click, instant diversification. You basically stop betting on one unpredictable horse, and you just buy the whole racetrack.
All right, let's talk about mistake number 4, trying to time markets.
It's a total illusion that you can somehow outsmart the global economy by sitting in cash, just waiting for the perfect moment or an impending crash to buy in. Doing this introduces a silent portfolio killer called cash drag. When your money is just sitting there in cash, it's not growing, it's not earning a thing, and it's actually quietly losing its purchasing power thanks to inflation. The research on this is just completely overwhelming. Time in the market always beats timing the market. Actually, studies show that missing just the 10 best market days over a couple of decades can roughly cut your total return in half. No way, right? And remember what we said earlier, those best days almost always happen right when the market timers are hiding in fear.
The fix here brings us right back to our good friend dollar cost averaging, investing a fixed amount on a strict schedule no matter what the market is doing. Honestly, think of it as a boring but absolute genius habit, kind of like paying your utility bill. You completely stop trying to play psychic. When prices are sky high, your fixed cash naturally buys fewer shares. But when the market crashes, that exact same fixed amount automatically buys way more shares. It essentially forces you to buy on sale without you having to think about it. It's brilliant in its simplicity. Finally, we arrive at mistake number 5, hidden fees and dangerous leverage. We live in this era of commission-free trading, which makes people think investing is totally free. Well, it's not. Now, what's really interesting here is the immense difference between these two scenarios. That huge missing chunk on the left, that's what happens when you ignore expense ratios. An actively managed fund might charge what sounds like a tiny, harmless 1% fee, but over decades, that 1% quietly eats a massive chunk of your final wealth. Think about it, you take 100% of the risk, but the fund manager takes a guaranteed slice of your total returns every single year. You absolutely have to pay attention to this.
And the second head of this monster is leverage. That means investing with borrowed money, or trading on margin. These apps make it terrifyingly easy to do. The appeal is super obvious, right? Borrow money, double your position, double your gains. But using leverage as a beginner is literally like learning to drive in a Formula 1 car. The speed feels amazing right up until you hit the wall. Leverage cuts violently deep on the way down. A normal market drop becomes a completely devastating loss, triggering margin calls that force you to sell your assets at the absolute worst possible moment.
So the rules for this section are incredibly clear-cut. Number 1, obsess over low fees. You can't control what the market does, but you have total control over what you pay to be in it. Stick to broad index funds with rock-bottom expense ratios. And number 2, zero leverage. No margin, no borrowed money. Go into your app and turn off the borrow button right now. Your ultimate goal here is to get wealthy slowly and surely, not get rich by Tuesday only to go bankrupt by Friday.
Stepping back for a second, look at the common thread running through all 5 of these mistakes. Operating without a plan, emotional trading, betting the farm on one stock, trying to time the market, and using leverage. Every single one of them stems from impatience, from trying to get rich quick. To succeed, you have to completely flip that mindset. Investing is a marathon, not a sprint. The market is an astonishing wealth-building machine, but it is brutally efficient at taking money from the impatient and handing it straight to the disciplined, long-term investor.
Avoiding these 5 traps puts you light years ahead of the average beginner. But before we wrap up, I really want to hear from you. Which of these 5 mistakes have you struggled with the most, or maybe watched a friend make? Be honest, we are all learning here. Drop your thoughts in the comments below, share this explainer with someone who's just starting their own financial journey, and let's keep building wealth the smart way.